what's next for your business. I'd like to thank Peter for participating. It seems like it was only yesterday, which is almost 4 years ago, that we had the first Andersen economic update, and lots of things have happened through that process. And I think you're going to learn today there's still a lot more to happen. We're going to have a question and answer at the end, but while Peter's doing his presentation, please feel free to put your questions in the chat bar, and I'll consolidate those questions and we'll have an open flowing discussion with Peter. For everybody watching in here, we are recording this webinar and it will be sent out to all those participants shortly after the presentation. So I'd like to introduce Peter. Peter's been a longtime friend, colleague, and someone that I communicate with on a daily, weekly basis about where the economy's going, the things that are going to affect clients, how they're going to affect the Canadian economy. Peter is a PhD from Harvard. He worked for the Bank of Canada. He was a consultant at Woods Gordon, and he is an advisor to some of Canada's most successful family-run businesses. And so without further ado, we'll let Peter take it away.
Hey, Jason, thank you very much. And for those of you on the webinar, thanks for your time. I hope I can say a few things that are useful and will help you in getting ready for 2024. In fact, that's the title of my next monthly economic report. Get ready for 2024. And you know, it's been a different ballgame for me and for people who try to predict business conditions, because the ground rules have all changed, and the pandemic has altered and fundamentally shifted so many of the basics. As far as forecasting economic developments, typically we in the past have relied upon established cause and effect behavior. And that would be typically the cause and effect behavior that has been in place since the end of World War II. I remember when I myself worked at the Bank of Canada, we built an econometric forecasting model that would forecast consumer spending, housing starts, business investment, by looking at how these interacted with business conditions, with interest rates, with economic monetary policy, and so on. And it's almost, Jason, like the rules have changed on us. And so, admitting my humility on this, I would go back to the Great Depression and the leading economists during the 1930s and through the war years, getting into post-war conditions. They all thought we were going to have another recession / depression in 1946, 47, and 48. And they were all proven to be wrong. In fact, no one was prepared as far as the economics profession. The great economists all got it wrong. Instead of slipping into a downturn again, we had this huge amount of pent-up demand and this huge urge to make up from missing out. And all of the population growth and the family formation and all of the spin-offs that came out of that gave us some really great post-World War II recovery years. So there's an element of that in what's going on right now. The business cycle ups and downs of the last 60 years or so, 70 years, they seem to be all different. So, Jason, it's really important to keep your finger on the data and to try not to get misled by opinions. In what I do, there's a lot of bias out there in what you hear about financial markets, about what the economy will be like next year, what the stock market will do, and what interest rates will do. And one of the problems, Jason, is that so many economists actually have bosses who have business plans. And so you have to be able to separate out the business plan from the forecast. And I'm not pointing out anybody in particular. I mean, we've got some good economists out there that I really admire and pay attention to. But it helps to be independent and to be skeptical and to try and get the story right. So I don't have to have a president or a CEO that I answer to. I try to get it right and to focus on data and not let opinions this way and that way sway me. So let me tell you one opinion that I do not believe. I do not believe that we are going to see interest rate cuts by the Fed or the Bank of Canada anytime soon. It seems that there are a lot of people out there, Jason, who think that interest rates are going to be coming down in, let's say, early summer of next year. Certainly by mid-year, a lot of people think interest rates are coming down. So if that's the case, hey, why hold up? Just jump onto that stock market and buy those stocks that have come down over the last month or two or three. I don't believe that at all, because the way I see it, the year 2024, I think, is going to be a year of worsening business conditions. And I think what we have a toxic combination out there already. We do have high interest rates. High interest rates. I think they're going higher, actually. That's my call. Again, an opinion, but an unbiased opinion. And I think we've got tight credit as well. Now, there's confusion, of course, because the housing market, the housing sector is different from 2008. You know, we don't have an oversupply of housing. We're short. We have a shortage of housing. We don't have, I don't think we have risky mortgages. So I don't think we face defaults and foreclosures on mortgages. On the other hand, I think that we are going to be stuck with, I call it, and I'm not going anywhere on my slides yet, I think we're going to be caught with the elephant in the room. In other words, the 10-year US government bond yield, the 10-year treasury, let's call it that. I think it's going to be 5% and stuck there for some time. So Jason, that means that the market capitalization rate that you're going to put onto any commercial property, especially an office building, means that the value of that collateral, the value of that asset is going to be really cut sharply with that kind of a higher discount rate on future revenues from that kind of real estate. Anyway, let's getting into details a little bit. My basic message is, everybody, I'm saying 2024 is a time to be cautious. I think that the underlying problem is inflation risk. And that gets me into, I guess, the first slide. I think that we are at serious risk of a second round of inflation. And I see it coming from a wage price spiral. Now, we all know things are expensive. We can all talk about examples of, guess what I spent on getting this, or guess what I spent on getting that. I just had a trip. Guess what I had to pay for this? Guess what I had to pay for that? So there really is this pressure to catch up on the cost of living. And it's all around us. But, you know, the cost of living issue and the cost of living irritation, it's because of yesterday's inflation. It's yesterday's inflation. It's what's happened in the last 6 months, the last 12 months, the last 18 or 24 months. So people are trying to catch up with what has already happened. And that's why I think we're stuck. I think that this demand for higher wages is here, really, and it's going to get worse. Right now, wages in Canada are running in the 4 to 5% increase. It's actually closer to 5 and 4. I think that's going to get worse, and there is no offset. Productivity growth, should be able to keep selling prices under control, even if wage costs go up, but they're not. Productivity is absolutely terrible in Canada. It's much worse than in the United States. It's actually going the wrong way. So what we have people out there who are aggressive and pushing hard to get paid more, and they have no fear of job loss, no fear whatsoever. And I don't think that's going to change. Even if we have weaker business conditions in 2024, I don't think that staff will be worried about layoffs. They're not going to be worried about job loss. I think they're going to push hard. And then you've got what's going on in the United States and specifically with the UAW. Jason, that 40% number is just in people's minds. 40% over 4 years. President Biden appeared on the picket line, and when asked, he said yes, he thought that was a good idea. 40% over 2 years. I gather that the latest offer out there is 25% over 4 years. So, 25% over 4 years. So, Jason, what is the compound annual rate to have a 25% over 4 years? That's close to 6, isn't it? It's something like 5.75% is the compound annual rate of increase in order to get a total of 25% compounded over 4 years. So anyway, my worry, everyone, is that people will pay attention to what the UAW gets. And the UAW, they're going to there's going to be a lot of congratulatory high fives when the deal finally comes in. They will do a victory lap on the media when they finally do get their settlement. But people will listen, people will hear about it. It'll be a pattern setter. And it'll affect other industries, I think. And it will also affect Canada. In the United States, you've got about a 10% unionization rate. About 10% of the US workforce is unionized. I think it'll spread out into the non-union sector in the United States. In Canada, hey, skill testing question, Jason, what would you say the unionization rate in Canada is? You got your
20%.
I would say 30%. I would say 30. It's big anyway. So what I'm saying here is, even though the Bank of Canada held off from raising rates today, it really doesn't matter, because a lot of the important interest rates aren't set in Ottawa, the Bank of Canada's boardroom. They're set in the trading desks on Bay Street. It's the bond traders that decide what's going to happen with really important interest rates like the 5-year, the 10-year, and longer interest rates. So I'm saying that we're stuck, I think, with higher interest rates because of what's in people's minds. And I don't think that inflation is going to come off anytime soon. In fact, I think we're going to be stuck with an inflation rate higher than 4% as we go through 2024. The Bank of Canada, in its press release this morning, is forecasting that inflation will be running at around 3.5% through most of 2024. And then it will go down to closer to 2% in 2025. The problem is this, Jason. The Bank of Canada is not too good at forecasting inflation, because we heard earlier that inflation in Canada would be running at around 3% by the middle of this year. Okay. Well, that's not the case. It's closer to 4%. And it's not the middle of this year anymore. So I'm saying that this inflation risk in the United States, the second round, this wage price spiral, workers just not worrying about job loss, workers trying to catch up with what's already happened to inflation. I think we've got a problem with interest rates as we go into next year. Anyway, I talked a little bit too long on that first slide. I apologize for that. So this next slide, slide number 2, it's easier. It just illustrates the point. Now, let's kind of look at what we've got on the screen. We're looking at wages, okay? We're looking at Canada. We're looking at wage inflation in Canada. And each one of these bars shows you what average wages are compared with 12 months ago, okay? So if you look at this diagram, kind of from the middle to the right-hand side, you can see from January of this year through to August of this year, the average was 5%, 5.0. That's January to August. Hey, the latest month is September. Guess what? It's also 5%. So there's no slowdown here in wage growth, even though the Bank of Canada this morning was saying that what they've already done with interest rates and this slowing down in the world economy, and also a slowing summer in Canada, that was easing inflation pressure. Hey, I sure don't see it looking at wage inflation. And Jason, you and I know that wage costs take up a big part of company selling prices. So there you go. And we don't have any productivity offset to that. So that's kind of core issue number 1. Now, as you know, I was a little bit late getting my monthly report out last month, and I have an excuse for that. I'm not going to go into details. So my release date was October the 6th. October the 7th was when I heard about this new Middle East war. Now, I'm choosing my words carefully because I think this Middle East war is going to be a Middle East war, and I don't think there's any way out of it. Now, if you ever get in a fight, Jason, especially, let's say you're a hockey player and you get in a fight with the guy who's the enforcer on the other team, you want to make sure that the referee is pretty close by, because you always know that the referee will come in and break up the fight if things go wrong. But this is not necessarily going to happen in the world of geopolitics. I think this thing could go on for a long time, and who knows where. I don't know where. You don't know where. Nobody does. But I tell you this, I can remember I'm not going to say that, make me sound old. In 1973, we had, on the 6th of October, 1973, the breakout of the 1970s Middle East War. And oil prices doubled, okay? They doubled between July and August and October of that year. And by January, they doubled again, okay? So that brought on a 16-month recession. Recession started in November of 1973 and it stretched all the way into March of 1975. So there you go. This is the risk right now. Take a look at oil prices. This is the next slide. Next slide. There you go. Return to 1973. Now, oil has really been vulnerable. But let's take a look at the diagram a little bit more closely. Take a look at the left-hand side of the diagram. Hey, oil made it look easy, Jason, to bring inflation down. Okay? Oil made it really look easy. Made it easy for the Bank of Canada and the Fed to say, hey, what we've done, we've raised interest rates and inflation's come down. Well, thanks to oil, it really did come down, but that's reversing itself right now. So I really don't know if oil is going to $100, $120, $150. I don't know. But all I can tell you is that this is an additional tipping point risk. So again, look at the middle of the diagram. Oil was $70 a barrel in June. This is West Texas Intermediate. Every data point on this chart is a monthly average, okay? Except the most recent data point, which is for October. Now, Jason, this is a problem because I sent Tanya the most recent information I had as of yesterday, okay? On the 24th, oil was $84 a barrel. West Texas Intermediate, 84. Any guesses on what it is today? Well, it's higher, I'll tell you that. 85, 85.22. So this is bouncing around a lot and it's got upside risk. It's got upside risk. So if we've got a problem with a cost of living catch up and a wage price spiral, you know, wages go up trying to catch up with the cost of living, and whoops, prices go up, and whoops, prices go up, well, then wages go up, and it's a spiral. Anyway, this could definitely add to the problem here. And let's hope it doesn't. But there's a real risk here coming from energy and the price of oil. And finally, my last slide is the elephant. My last slide is the elephant. And this shows you the 10-year US bond yield, you know, the famous 10-year treasury at a 16-year high. Okay, now yesterday, the treasury, the 10-year treasury came in at 485. Before our webinar started today, I figured I'd better check. It's almost 5 now. It's the last quote I got was 4.955%. So yeah, you know, the Fed doesn't announce its interest rate decision until next Wednesday, which is the 1st of November. But tomorrow, the US government is going to release results for the September quarter, and the growth rate, Jason, is going to blow the doors off. The Federal Reserve Bank of Atlanta does what's called a nowcast. And what they do is they try to track the gross domestic product calculation by looking at all the available data that's in the public domain. And their number comes out at a 5.4% annualized growth rate from the second quarter to the third quarter in the United States, 5.4% annualized. We haven't seen anything like that since 2021. Interesting, right? With the price of oil edging higher, wage settlements a problem, risk of a wage price spiral. If you or I were running the Fed, we would raise rates next Wednesday. But, you know, they might decide to look at the Bank of Canada's playbook and bend a bit to political pressure and wait and see until it was absolutely clear that we had an inflation problem that is just not going away. So anyway, that's basically what I'm saying. And this particular diagram on the elephant on the 10-year bond yield, it spills over into Canada, because if you want to forecast 5 and 10-year bond yields in Canada, get your forecast right for the United States first. Okay. And if you've done that, add on a little bit in terms of rate differentials, and you've got your Canadian forecast. But the important thing is, Jason, is that this is feeding into interest rates on both sides of the country, and it's feeding into mortgages. It's feeding into mortgages. I remember, uh, early in my consulting career, dealing with one of the major trust companies, it was made very clear to me by the investment officer that, hey, it's government bond yields that determine where mortgage rates are going to go. And not only that, it affects commercial real estate. So if you have a half empty office building, if you own it and you have to refinance that, the value of that collateral is basically almost cut in half. Maybe it is cut in half, depending on the kind of space, by this increase in the discount rate, increase in the market capitalization rate, also known as the cap rate. But think of it just as a discount rate on future earnings from that kind of asset. So anyway, I'm saying we've got a problem. And I'm not talking about soft landings or recessions. I'm just saying simply this, Jason, as far as my clients are concerned, and as far as your clients are concerned, get ready for 2024. Business conditions are going to worsen, and that's no fun. So have options, be prepared, have a strategy. Your thoughts?
I think that what you say is very true. And I look across our entire client base, and part of it is to try and educate our clients to be responsible and take ownership. And I think probably for the last 10, 15 years, they've done that in their business. I think one of the things that's happening in the items that you've indicated here, interest rates, wage spiral, oil, none of these things, any of them, they really don't have control over them. And I think the press, I don't know how good a job they do when they say that inflation is 4.1 or 3.7. Is it the median inflation? Is it the core inflation? Is it core inflation without oil? Somebody asked a question about oil, and oil is way up again, and inflation was down to 3.9 or 4.1, depending upon the number you use. Their question is inflation going to go back up to 8%, given the price of oil? And how does the everyday person actually interpret the Globe and Mail or the Wall Street Journal or the television when they talk about inflation, so they can actually have a better understanding on what it means to them?
Well, I think that as far as average people go, it's how much you have to pay for your breakfast cereal, the bakery items you buy. And the good news, though, is that even though the price of oil is headed the wrong way, it's interesting, the gasoline price hasn't reflected that at this point. In fact, in the United States, the national price, the average price for regular in the United States is down 30 cents a gallon from where it was a month ago. I can't understand that. I don't think it's going to last, but it's all part of the confusion out there, Jason. So people can jump and cherry pick on numbers to make whatever point of view they want to make. But I think that there is a bit of misplaced optimism out there. And one of the indicators that I look at is the VIX, VIX indicator. Okay, that's the implied volatility on CBOE options on the S&P 500 index. So you've heard of the Black-Scholes option pricing formula. That formula predicts what option prices should be. The volatility is one of the 5 or 6 components of that formula. So what you do, Jason, is you put in what the actual options price is on the left-hand side. Then on the right-hand side, you've got all the elements of what goes into the formula with the exception of volatility. And hey, if you know what the options price is, and you know what all the other elements are in the formula, well then, presto, the volatility number comes out as a residual. And right now, this changes, by the way. It's there on the markets. It changes minute by minute. Right now, VIX. Oh, by the way, it's also known as the fear index. Okay, it's also known as, AKA, the fear index. Right now, we are looking at 21 as the value for implied volatility. Now, that's up from 14 in September. But going back all the way to 1990, when this thing finally was created, the average is 19. So here we are at 21 today. It's only slightly above the long-term average. So what I'm saying is that in the stock market, and looking at the S&P 500, hey, don't worry, be happy. Nothing to see here. Keep on going, you know? The stock market has not reflected anything like the risks that I think are out there with respect to inflation and interest rates and a coming worsening of economic conditions. Stock market has just been, hey, be happy, be lucky.
Yeah, one thing that, and I think all across North America in 2023, we've seen a huge impact from climate change, if you believe in climate change, in flooding, in storms, in hurricanes, in wildfires, and the effect that they've had on communities and the economy. And we're now seeing those have a direct impact on the availability of insurance with respect to residential and commercial properties, and some insurance companies denying insurance. What effect do you think environmental sustainability, climate change is going to have on the economy as we go forward?
Well, I guess it's structurally speaking, you're right. It's going to be a longer term cost item, isn't it, Jason? It's going to be a new cost element, making the cost of business or the cost of home ownership all the greater. I would just throw out the comment, though. Hey, Jason, it's 25th of October today. Let's talk about the hurricanes. That's what I call them. I call them hurricanes, not hurricanes, but hurricanes. It's my Texas accent. So anyway, we go down to a beach house outside of Galveston. We don't own it. I've always had the philosophy it's better to rent than buy when it comes to vacation properties. But they haven't had a hurricane down there for years. And that's always the deal, you know, because Patricia's birthday is in October. And quite often I'd say, hey, let's go down to that beach house in Galveston. And we'd say, no, second thought, there'll be a hurricane. There's always hurricanes, you know, from August running right through until November. Haven't been any hurricanes. So this weather thing is tricky. Sure, I know it's causing fires. And again, those fires that we saw in Canada, Jason, they weren't just 1 or 2 places. It was everywhere, wasn't it? And it's interesting. That's what the Bank of Canada jumped on this morning as one of the reasons that it would not raise rates, because it saw, you know, the economy stall out in the summer. And hey, that was partly because of the wildfires, the strikes, the port stoppages, and so on. Those are one-off things. So, but I agree with you. I think that it's tricky, and climate change as an issue is not going to go away. It's going to get worse, and it's going to add to a lot of unforeseen consequences.
With increased costs in our small medium enterprise business market, who employ a significant number of people, increased inflation, what effect do you think it will have on unemployment in Canada?
I think it's all changed. I think that the pandemic has changed the rules, Jason. I think that my clients, probably quite a few of your clients, remember clearly the job shortages, and they don't want to be cut short of workers. So even though business might be slowing down, do you really think we're going to see much in the way of layoffs? Now, we've seen some, I'm not going to name names, but we have seen some layoffs. But I think by and large, employers are going to be very unwilling to lay off workers, even if business slows down. Now, if business does worse than slow down, if it's more than just kind of a, growing at 1/3 the rate you want to, or growing at 1/3 the rate you grew at last year, let's say it's a negative, well then, yeah, push comes to shove and, people change their minds on that. But where we stand right now, you survey your members or your survey your clientele, I think there's a reluctance to lay off workers at the present time. So it's all different, isn't it? It's
it
like the last 3 years have really changed the cause and effect relationships. You're not going to see the job losses. And that's why the housing market is going to be sustained, because housing really depends on jobs and employment. And if we don't have, big cuts in jobs, well, then it seems to me that housing has got some underlying support.
There's talk about livable basic income in Canada, and one of Mr. Trudeau's brilliant ideas. How do you think that's possible to be implemented, and what effect would it have on employment and productivity?
You mean a basic guaranteed income?
Yes.
Oh, Jason, take a trip to Norway, take a trip to Iceland. I think that it takes incentives out of the system myself. But again, that's a personal view. And I'm not going to, kind of go onto the internet with that view. But I think that's a problem. If everybody gets a guaranteed income of $50,000 or $60,000 a year, no sweat, no worries, well, there you go. I think it takes incentives out of the system, and I'm kind of a person who believes in incentives. That's a personal comment. What do you think?
I think that with all the problems and the issues that we have in Canada and the size of our deficit, and the shortage of labor that you talked about, and people fearful of laying people off because they can't replace people, I don't know that there's a need for it. I think we have a lot of social network support systems in Canada already.
What I would do, Jason, is rather than get involved in handouts, I would get involved in more skills training, and let people take advantage of skills training. And also, in addition to skills training, I would think language training as well. We have, awesome immigration numbers in Canada, which is wonderful. But I think that I would pour more money into English as a second language type of training, so as to make people feel really confident in if English is not their first language, really confident to get their language skills up to a level where they can get involved in technical training and higher level jobs that meet the needs of of the future.
There's a lot of talk about immigration, a million immigrants a year. But there's also a significant discussion about how much of that is permanent immigration, how much is it student related, and how much is it
Temporary
immigrants
person.
coming to Canada to get their PR and then going back to their home country.
Yeah. Well, I think it cuts two ways, Jason, because the immigration that we have, the big numbers, they're consumers. They need shelter and they also need the staples. So there's a demand component here. And as long as they're in the country, they're going to be consumers. In terms of joining the workforce, are they really going to be substantially involved in establishing workforce careers? I doubt it. So if we have a fundamental structural shortage of workers in Canada, I don't think the immigration numbers can be relied on to be the be all and end all solution to our shortage of workers. So kind of putting it in, kind of balancing that out, I'd say I would call that inflationary. I don't think that the immigration numbers are really going to help all that much on the supply side, but I think it's adding on the demand side. So to me, the immigration situation, to me, it's inflationary.
You talked about Q3 in the US, increase in GDP exploding. There was an article in the Globe and Mail this morning that talked about the GDP in Canada and where it's going. How would you compare the two economies, and how much closer to a slowdown in Canada? How much further ahead is Canada to a slowdown than the US?
I don't buy that. To me, they move simultaneously. And I think that the slowdown in Canada that we saw this summer was because of special events, one-time events, wildfires, strikes, port stoppages. And I think that there's going to be a post-special event rebound in Canada after that. So that's one of the reasons I think the Bank of Canada is not done with raising rates. I think that they have played it safe, perhaps from an institutional, bureaucratic, political point of view, but I think they will face compelling pressure to raise rates as soon as we get into next year. And that's January 24th, the date for next year's rate increase, the first one. So basically, I would say the two economies, I don't believe in a made in Canada recession. And if the US is going to have a recession, I think there'll be one in Canada too. But things are different today, and it very well might be, the economies in both countries are maybe not so deeply connected to interest rates as you'd think. And immigration is one of the factors in Canada that I think is going to continue to boost Canada's economy. I think it's inflationary, but I think it'll boost demand. And then government spending. Hey, the Minister of Finance has done exactly the opposite to what the Bank of Canada is trying to do. They've been pumping fiscal stimulus into the Canadian system, while the Bank of Canada has been trying to cool it off. So it's like one foot's on the accelerator, one foot's on the brakes.
Yeah, one of the things that I've started to see with our clients, and we've just put up this slide, and we have these discussions on a regular basis. And have you thought about how these affect your business? And I think these 4 or 5 bullets, unfortunately, for the first time in a lot of people's business life and owning their own businesses, they've had little control over 4 or 5 key components that go into their business. Interest expense. If you have commercial mortgages, the renewal of that long-term debt and the cost of it. We're seeing clients that are going from $7 a square foot to $18 a square foot. Increase in utility costs. as we talked about increased payroll costs, but not just the increased payroll cost. In Canada, there's going to be a significant increase in the cost of CPP, foreign currency, which is something that people don't have control over. And I don't think people have stepped back to calculate how this can affect their business going into 2024. I know you advise a lot of clients on these things and how the economy is going to affect their business. If you were a small and medium enterprise in Canada and you're advising your clients, what would you advise them to do to try and get these things under control so that in 18 or 24 months, they're still around?
I would really try to get into a risk management strategy. You know, risk management is one of those things that people put aside. It's like making your will. It's always a good idea, but let's not do it today. Let's not do it until sometime in the future. So risk management is something that's no fun. It's like going to the dentist, actually. My advice is to look at the risks that you can figure out and look at the risks that you haven't thought about, and what is your exposure to those risks, and how much could you lose by getting involved in those risks. And I would always say that rule number one of risk management on my list is don't go there. And if you have to, go with somebody else who's not as fast a runner as you are. So that would be my one point, Jason. And I guess the other point is that it's really the next 3 to 6 months that's going to tell the tale on how bad it gets. And why take a risk in the next 3 to 6 months? Why not wait until this time of year from now? Because by then, chances are that things will have settled out, and the particular problems that you might face in your business, well, then you can look at them straight on, because a lot of the surrounding problems, like the macro economy and all of that, should be resolved. You know, so when the tide comes in, all the boats rise. And that's what we're hoping for the economy come this time of year from now, that whatever happens in the next 6 months, 9 months, by the time we're into Q4 of 2024, we should be looking at a rising tide and an accelerating economy that has got sustainability on that new uptrend. So why take chances now?
So to summarize, why go to the house on the beach when there's going to be a storm? Wait until the storm's passed.
Yeah, exactly. And how about my idea of an asymmetrical loss function? What would you rather do, Jason? Would you rather lose money by being too cautious and be proven wrong? Or would you rather lose money by letting it all hang out, take chances, be aggressive, and be wrong? And can you calculate how much you'd lose either way? What would your preference be? My preference would be I'd rather lose money by being too cautious right now than being the other way. So I would say cash is king for the time being.
I think anytime you have volatility, there's upside and downside. And in this next 6 months, as you sit on the side and be cautious with respect to risk, there will be opportunities that present themselves. What do you think some of those opportunities may be?
Well, Jason, one of the things that worries me about the volatility, do you think that artificial intelligence is out there creating some of that volatility? I mean, we all know that artificial intelligence can be applied everywhere to everybody's business, including financial markets and predictions of financial markets. So It used to be that it was the traders on the floor on Bay Street that used to be driving markets, but I'm not so sure anymore whether it might be a big room full of computers with lights flashing on and off that are deciding what kind of volatility we're going through.
On that note, I'd like to thank Peter on behalf of all of our participants today. It's been enlightening. Peter and I've had these discussions for a long time, and the words that I always remember that Peter echoes when we hit these times that aren't so much fun and there is so much volatility are cash is king. I don't know how many years I can go back when you first said that. And I can go back and look at the times, and I think you were probably correct every time. So, Peter, thanks very much. If people have any questions, they can forward them to me or Tanya, and we will hook up with Peter and get those answers back for you. So again, Peter, thanks very much. Thanks everybody for attending.
Thank you.
Enjoy the rest of your day.